Welcome back, traders. It's August 18th, 2023. Here's my general market update. It's approximately 11:15 Eastern Standard Time on Friday. Reminder, the presentation's by Rain King LLC, and I'm an amateur individual growth stock investor. Here's our agenda. We're going to go quickly over the indices, some market internals. Then we'll look at the Q2 13F filings by institutions and look at some interesting data in that filings. Then we're going to look at the leader, NVDA, and what is it telling us about the market, and then we'll wrap up with a summary. So the indices. The big picture, we talked about the NASDAQ. We're kind of monitoring this weekly pullback. We're in the third week down. What's noticeable about this week is we've broken sharply the 10-week moving average, and right now we're near the lows. So that's not good. I don't like the acceleration that we're seeing there. So maybe this script becomes different than the previous two markets in 09 and 03. We have to keep just monitoring it week by week. So let's look at the S&P and the NASDAQ. I'm looking at, on the left is the Qs, the NASDAQ 100, and on the right is the S&P. So on the NASDAQ, we can see that this gradual pull down has gotten even more sharper and steeper. We broke the 50-day a week ago, and then we really looked at possibly getting support at the 65-day. Even that is broken, and now we're down to undercutting the mid-June lows. So we're actually on the Qs, we're off 8.6%, and it really is telling us that this is not a gentle pullback. This is something more. In my work, when you get a correction back, a pullback that gets into the 8 to 12% range, that's really a correction. And the difference being it would require a new follow-through day to really reinvigorate an uptrend. So that's the distinction about now that we're off at least 8%. Now the S&P is off 5.8%. You can see it's just above the lows from June, but it's still, there's this acceleration. It's been a lot of distribution, so it's not a good picture. And, you know, we had speculated that maybe we would get support and see accumulation by institutions at the 50-day, the 65-day, and we didn't get it. There you can see big red spikes. There's distribution going on. There's rotation out of growth names. And you can also see that evidenced in the up-down volume ratio on the Qs is actually below 1. So that's really significant. We have not been below 1 all the way back on this chart, way back until like March or April. So let's look at some internals. This is the NASDAQ new high, new lows. And again, a disturbing picture. We've seen a complete shrinkage of new highs on the NASDAQ, and you can see new lows in red have been expanding. We talked about it last week, and it's gotten even worse this week. This is a big negative. This is telling us we need to get very defensive. Our new lows are actually up in the range that we had back in March and April. Again, it's just a negative piece of information when you put together some of the pieces of the puzzle. Looking at the S&P percentage of stocks above the 200-day moving average, you can see that as the market started to peak out in late July, this has been a very sharp decline and deterioration. We were over 75% above the 200-day, and we've rapidly gone down to below 56%. Looked so good a few weeks ago, but it's really deteriorated rapidly. So that's a really bad sign. The overall advanced decline line is trying to make a stand, but there are so many other things outweighing it right now that you really wonder if the AD line will break this little uptrend as well. So here's a chart showing the S&P high beta stocks and dividing them by the S&P's low volatility stocks. And you can see here the general trend since the market peaked in late July. You know, basically the line is going down, which means that low volatility is actually starting to outperform and high beta is not. Kind of makes sense because high beta names are growth names that we typically invest in, and they are underperforming since the market peaked, and fund managers appear to be looking for more lower volatility names as we go through this correction. Now, this is the 10-year Treasury yield. We've had this very, very sharp run since the market tended to peak. We have not seen this high of yield since the market bottom of late last year, way back here in September, October, and it's actually pushing into new highs, which is concerning. I've also shown on the right side of this chart, this is the CME Group's Fed watch of interest rates. And you can see here that they do a forecast of what they believe is going to happen with the Fed. And this shows right now the Fed meeting. This is the current interest rates, 5.25 to 5.50. Only 12% of market participants are seeing a rate increase of a 1/4 point in September. And if you go out one more month to the next Fed meeting in November, 33% are seeing a 1/4 point rate hike in November. So if you're interested in this stuff, go to cmegroup.com/market/interest rates and poke around. You can get these charts for future months. This to me is a little bit concerning. Rates are going up. The inflation data, some points are coming down, but it's not coming down consistently, which means that possibly the Fed continues to make rate hikes in September and possibly November. So the higher bond yields are offering investors a safe return of almost 5%. This is going to pull money away from risky growth stocks, and we're seeing that as money is pulling out of growth. As I mentioned, if Jackson Hole is coming up next week, if the Fed is hawkish after their hawkish minutes that were released this week, this could shock the market further into adjusting itself to the fact that there might be a September rate hike of a 1/4 point, which right now we're seeing they don't expect that. So there seems to be a disconnect going on between the Fed and rates and what's going to happen next. I will declare I am no macro expert at all, but this looks very, very much a disconnect to me on the surface. Now I want to switch to the Q2 filings. Mutual funds, institutional funds have to file what they hold, what they sold, and the reports are not released until about 6 weeks after the quarter. So I thought it'd be good to look at a couple of interesting filings. So here we go. Let's go to the source. Here's O'Neill Global Advisors. And this is a chart that takes what their biggest positions are, ranked from percent of the portfolio. And you can see NVDA is an 18.7% position for O'Neill Global Advisors as of the end of the quarter in June 30th. And it just ranks them all. Now, I've noted in color new positions that O'Neill initiated. They bought a position in MongoDB. They bought positions in Google, Class A and Class B. They also bought a new position in Shockwave, Intuitive Surgical, American Airlines, and others. So there were some interesting things there. And I also picked off a few of the big sells that they made during the quarter. O'Neill's Global Advisors sold off 97% of their SMCI holdings. They also ditched Monday.com. They also dipped Samsara and PNW, which is Palo Alto. They cut 50% of their holdings. So it's always kind of interesting to peek around and see what they're doing. Now, here's where the current prices that we had, and I kind of colored them. They show in the report roughly what their average price they paid. And I put in black if it's a position that's profitable, in red if they're underwater. You can see here there's quite a few positions O'Neill holds that are currently in the red. So I picked off 3 of the charts of the new positions that O'Neill took. MongoDB I mentioned, and I just drew a line saying this is what they're saying the average price is paid. So that position right now is probably underwater. Intuitive Surgical, again, they bought up in this range according to the report. That's underwater. And Google, Class A, they bought earlier, and they have a pretty good average cost. So they're in the black on that, and they have doing okay with that. So that's one of the ones I looked at. And the second one that I looked at was Stanley Druckenmiller's. So the Duquesne Family Office Institutional Fund is Druckenmiller's fund. So here's what they had to say in theirs. Again, here's their current size of position. You'll notice that he also has a 14% size position in NVDA. And you can see here in green, his new buys were GE, BLDR, which is a housing stock in terms of supplies and materials, and PTC was also a new buy. And you can see where he had some reductions, reduced Eli Lilly, and some other positions in here. His major sells for the quarter were Google. He sold 100% of his 4% position. He sold FCX, he sold AMD, and he got out of GOLD. And you'll notice here that one of his biggest positions, the number 2 position in his portfolio, was Coupang, and he actually added to that particular stock quite a bit. And he average costs was 38, and the current price is actually only 18.50. So let's take a look at some of these charts that he made new positions out of or added. Here's Coupang. Again, according to the report, he has an average cost somewhere up in this range. He just made some more purchases down here. He's had this position for literally years. So he obviously has done some research, and he believes that there's going to be something good happening out of this. It's a Korean stock. So we'll see how that turns out. Builder First Source, I mentioned, is construction materials, housing materials. Here's his average cost line. And PTC is 2D, 3-dimensional design software, engineering software, where he made a big, not a big, but a purchase in the quarter. So it's just kind of interesting to poke around at those. If you're interested in looking at filings, I got this from a site called whalewisdom.com, and you can look up any fund that you'd like. So let's look at the leader. And the leader is NVIDIA, and we've talked about this one last week. Here's what we talked about last week. We talked about the 65-day potentially being a support line. We also talked about the 1 trillion valuation, which is roughly around 409, was another potential area of support. And maybe NVIDIA would bounce, or maybe it needs to have a base. So where are we today if we look at this chart? Well, here we are as of 10:05 a.m. Eastern time. The blue line is that 409, 1 trillion level. And you can see NVIDIA came down and actually got support right at the 65-day EMA and the 1 trillion valuation, and had a very, very strong reversal up on Monday. Now, the problem is that didn't get a lot of follow through. You can look at the chart and you can see that the stock ran and stalled out in the 20-day exponential moving average. It couldn't close above it. 1, 2, 3. And here's the action today coming down. Now, there was a big price target increase. One analyst is saying it's an $800 price target on NVIDIA, yet the stock is down today. So that's not a good sign. If an $800 price target can't move this stock, what is that telling us as the earnings are coming up next Tuesday? So maybe this is all just telling us that NVIDIA needs to make a real proper base. Hasn't had a base in a long time. You'll notice that the up-down volume at the bottom of this chart is also below 1. NVIDIA, the leader of the uptrend, is struggling. It's no longer showing accumulation at the moment. So let's wrap up. Now, this pullback continues to deepen really into correction territory. Now, if you're using your tools, as we have been every week, looking at new highs, new lows, we're looking at the indices, distribution, you're kept on the right side of the market. The market has been gradually pushing us out the last 2 to 3 weeks. So hopefully you've been paying attention to those and moving to a more defensive posture. We said keep our eye on NVIDIA next week, Jackson Holes next week. So there could be things that influence this disposition about a potential September rate hike, or does the Fed decide to pause in September? Again, if now that we've corrected almost 8%, it's really a situation where I would believe that we would need to see a follow-through day in order to turn the trend back up. Again, Fed meetings minutes were hawkish this week. Jackson Hole's coming up. Fed Watch is showing only a 12% chance of a September rate hike. There could be a real disconnect here with bond yields really rising. So they're telling us that rates might go higher. I'd be avoiding any new buys at this stage. We really want to be in a defensive posture, and exposure levels should be really coming down as you're being pushed out of the market if you're paying attention. Maybe you have a 0 to 25% exposure at this stage, and I would only have that exposure if you have some big cushion in some names that you have conviction in. Defense is clearly the priority right now. If you have a little small gains, you might want to bank them to cushion against further downside. So everybody's a little different. Some people may have gone to full cash, and that would be acceptable given what we're seeing, which is a fairly negative picture in the indicators that we look at. So the quote of the week this week is from Gerald Loeb, and it's making a commitment is many times easier than closing one. And this is all about being flexible. 2-3 weeks ago, we were probably getting more and more bullish, but things have turned dramatically different. And so we need to be flexible. And that means sometimes if you have small losses, sometimes taking that small loss is the best loss versus hoping that a stock will turn up when maybe the indexes are primed to go lower. So consider that. And again, just a quick reminder, the Blue Sky Investing event will be coming up on Saturday, November 4th, all-day virtual event. We'll have more information soon, and we'll be announcing the speakers in the next couple of weeks. So put that on your save the date. Well, that will wrap it up for the general market update for August 18th, 2023. Enjoy the weekend. Here's where you can find me if you want to reach out.